What is going on, everyone, and welcome back to Explain the Charts. Today, we are diving deep into XAUUSD, or gold, which has been on an absolutely historic run. We're going to break down the major news driving the market and then jump straight into the charts to see what could be next. First, let's talk about the headlines because you can't ignore them. Gold has smashed through the psychological $4,000 per ounce level for the first time ever, fueled by a perfect storm of macroeconomic factors. A primary driver is the overwhelming expectation that the U.S. Federal Reserve will cut interest rates again at its meeting on October 29th. The CME FedWatch tool is showing a staggering 94.6% probability of another cut, which makes holding a non-yielding asset like gold much more attractive. At the same time, we're seeing a surge in safe haven demand. Renewed U.S.-China trade tensions, combined with concerns over a prolonged U.S. government shutdown, have investors feeling jittery and looking for safety. This risk-off sentiment is further supported by declining 10-year U.S. Treasury yields, which are now hovering near 4%, reducing the opportunity cost of holding bullion. Central banks, particularly the People's Bank of China, have also continued their strong buying, adding another layer of fundamental support. So, with that backdrop of strong fundamental tailwinds, let's see how this has translated into the price action on the charts. Here on the daily chart, we can see the bigger picture, and it is a powerful one. Gold has been in a very strong, structural uptrend since the middle of last year, consistently making higher highs and higher lows. Notice the periods of consolidation followed by aggressive breakouts, which is characteristic of a healthy bull market. However, what's happened since the beginning of September is nothing short of parabolic. This incredible surge directly correlates with the increasing certainty of Fed rate cuts and the escalation of global economic and political risks we just discussed. It's a textbook example of price action reacting to major fundamental shifts in the market. Let's zoom in on this recent, explosive move from early September. We can see the price accelerated from the $3,500 to $3,600 area and just didn't look back. The momentum was incredibly strong, slicing through previous resistance levels with ease. On October 8th, price printed its current all-time high of $4,059. However, look at the candle on October 9th. We saw a significant reversal, a pullback of over 0.5%, closing below $3,990 after finding a low around $3,944. This is what news reports are calling a breather or consolidation, which is very normal after such a vertical ascent. The market is now trying to digest these massive gains and find a new equilibrium. The candle from the last session on October 10th shows some buying pressure returning, closing back above the key $4,000 level. This suggests that while the initial momentum has paused, dip buyers are still present. Now, let's switch to the 1-hour chart to get a closer look at the price action around this peak. Here we can clearly see the blow-off top on October 8th, followed by a sharp and swift rejection. This created our immediate and most important resistance level at that all-time high of $4,059. The subsequent sell-off established a very clear short-term support level at the low of that move, right around $3,944. For the last couple of days, the price has been trading in a range between this support and resistance. We can see some attempts to rally being sold off and dips toward the support being bought up. This choppy, sideways action shows market indecision in the short term. Drilling down even further to the 15-minute chart for the most recent sessions gives us an even clearer view of this consolidation. We can see the battle between buyers and sellers playing out in real time. The price is essentially coiling up after a massive expansion of volatility. This type of price action often precedes the next significant directional move. Traders are watching to see whether buyers can gather enough strength to challenge the highs again, or if sellers will take control and push the price below the recent support. For very short-term traders, the boundaries of this range are the key levels to watch. So, let's go back to the daily chart to summarize what we've learned and discuss potential scenarios. The long-term and medium-term trends are undeniably bullish, supported by strong fundamentals. However, the short-term picture is one of consolidation as the market is in an overbought state. Let's recap the critical price levels. The key resistance is the all-time high at $4,059. Above that, we have the psychological target of $4,100, which has been mentioned by analysts. On the downside, immediate support lies at the recent low of $3,944. A break below this would open the door to the psychological $3,900 level. Further down, a more significant support zone sits around $3,870 and the October 2nd low of $3,819. Now for our unbiased predictions. The bullish continuation scenario is still very much on the table. If we see the US-China trade rhetoric worsen or bond yields fall further leading up to the Fed meeting, expect another test of the all-time high. A sustained break and close above $4,059 would signal the next leg up, and I'd place the likelihood of this happening in the next few weeks at around 65%, given the macro environment. The bearish scenario would involve a significant de-escalation of geopolitical risks or an unexpectedly hawkish Fed, which seems unlikely. A daily close below our key short-term support at $3,944 would be the first warning sign for bulls. However, the most likely scenario in the immediate short term, I believe with about 80% probability, is continued consolidation. The price will likely chop around between $3,950 and $4,050 as the market waits for the next major catalyst, which is the Fed's rate decision on October 29th. So, keep an eye on that key support at $3,944 and the all-time high resistance at $4,059. A break of either of those levels will likely dictate the next significant move. That's our analysis for today. Before we wrap up, a quick disclaimer. This video is for informational and educational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always conduct your own research before making any investment decisions. If you found this analysis helpful, please hit the like button, subscribe to Explain the Charts, and ring the bell so you don't miss our future updates. Thanks for watching, and we'll see you in the next one.